SCHD has been called boring, dead money, even a yield trap. And yet, heading into 2026, a lot of investors are asking, is this finally the year SCHD makes a comeback, or is it smarter to go all in on growth? Today, we're answering that with real numbers, realistic projections, and a simple framework you can actually use. Before we get started, quick question for you. How many shares of SCHD do you own right now? Drop a number in the comments. 0 is a valid answer, and I'm genuinely curious where this community stands. And if you're new here, my name is Steve. I invest consistently and track real results. I'm not here to sell hype. I'm here to figure out what actually works in real life with real money and real emotions. Let's start with honesty. If you bought SCHD expecting QQQ level returns, you're probably disappointed. If you bought it for income and stability, you're probably fine, maybe even sleeping better. SCHD is built around quality dividend companies, not the highest yield, not the hottest AI stocks. So when markets are pouring money into tech and growth, SCHD can feel stuck in traffic while QQQ flies down the highway. But here's what people miss. Flat price action feels like nothing is happening. With SCHD, you might watch your account balance barely move for months. The scoreboard isn't just the price, it's ownership and cash flow. Every quarter, you're getting paid in actual dollars hitting your account, whether the market cares about SCHD that day or not. Quick context here, SCHD did a 3-for-1 stock split in October of 2024. So if you see older posts claiming much higher per share dividends, that's pre-split math. Today we're using current post-split numbers. Now, why do some investors, including me, think 2026 could favor dividend strategies? 3 reasons. 1, if interest rates stay lower or stabilize, income-producing assets like dividend stocks become more attractive compared to keeping money in cash or bonds. 2, if growth stocks valuations cool off or get too expensive, money often rotates into quality dividend-paying companies. And 3, if market volatility returns and we see big swings up and down, dividends feel like a psychological anchor. You're still getting paid in cash even when markets are chaotic. SCHD holds companies that aren't riding AI hype. Consumer staples like Pepsi, healthcare companies, industrials, financials, these aren't stocks that 10 times overnight. They're businesses that grind, compound, and literally pay you while you wait. It's not designed to win every race. It's designed to be steady through different environments. Now let's talk about the numbers because this is where the real power lives. SCHD currently pays approximately $1.05 per share annually. So let me make this concrete with real examples. If you own 1,000 shares, that's roughly $1,050 per year in dividends today. And to be clear, that assumes you never buy another share. No reinvesting dividends, no adding new money, just holding what you already have. But the real magic is dividend growth. Historically, SCHD's dividend growth has averaged around 9 to 10% over long periods, but that growth has not been smooth or guaranteed every single year. Some years are stronger, some are weaker, especially after reconstitutions and changes in holdings. If we look at just the most recent years, growth has slowed compared to that long-term average. And that's why for this video, I'm going to be conservative and use 4%, 6%, and 8% dividend growth scenarios because I'd rather underpromise and overdeliver. Let's start with the conservative case. At 4% growth, your $1,050 per year becomes about $1,275 per year in 5 years and about $1,550 per year in 10 years. Not flashy, but steady. Now the middle case, at 6% growth, your $1,050 grows to about $1,400 per year in 5 years and close to $1,900 per year in 10 years. And now the optimistic but reasonable case, at 8% growth, that $1,050 becomes about $1,540 per year in 5 years and about $2,270 per year in 10 years. That's groceries, that's utilities, that's insurance. Those are real bills being covered by portfolio cash flow. You're not getting rich overnight, but you are building something real and reassuring. Now, important disclaimer, these projections are estimates based on historical trends. Past performance doesn't guarantee future results. Now, here's the biggest mistake I see people make, treating this as SCHD versus growth. That's a false choice. Smart investing is role-based. Think of your portfolio like a team. Different players have different positions. VU or VTI is your foundation. Broad market diversification at low cost. QQQ or SCHG is your growth engine. Higher upside potential, but more volatility. SCHD is your stability builder, cash flow, dividend income. Lower volatility, they do different jobs. And most investors don't fail because they picked the wrong ETF. They fail because they picked something they couldn't stick with emotionally, and then they panic sold at the worst possible time, often at a loss. So how does SCHD actually compare to growth ETFs like QQQ or SCHG in real life. Here's the honest trade-off. Growth ETFs can deliver higher total returns over long periods, especially in bull markets dominated by tech. But you pay for that upside with higher volatility, deeper drawdowns, and significant more emotional stress. In a correction or bear market, QQQ can drop 30, 40, even 50%. Can you handle watching your account fall that much without panicking and selling? Be honest with yourself. SCHD, on the other hand, tends to be less volatile, more income-focused, and psychologically easier to hold through market noise. The dividends act like a reward system, a paycheck from your portfolio. Even when the share price isn't moving or is down, you're still getting paid cash every quarter. And that matters when you're trying to stay invested for decades. Neither one is better. They're different tools for different purposes. If you're 25 years old with 40 years of investing ahead of you, leaning heavier into growth can absolutely make sense. If you're 55 and starting to think about retirement in the next 10 years, or just want that feeling of progress even in flat or down markets, dividend strategies can make a lot of sense. And for most people in between, let's say you're 30 to 50, a blend makes the most sense. You get growth potential, you get income, you get diversification, and you get a portfolio you can actually live with through different market cycles. So what does that look like in practice? A growth-leaning portfolio might be 60% broad market, 30% growth, and 10% SCHD. A balanced portfolio might be 50% broad market, 25% growth, and 25% SCHD. An income-leaning portfolio might be 40% broad market, 40% SCHD, and 20% bonds or other income assets. SCHD doesn't replace growth. It complements it. You're not picking a team, you're building a portfolio that works together. So what am I personally doing? I'm not selling SCHD and I'm not going all in on it either. I like SCHD for what it is, a quality dividend ETF that builds cash flow and helps me stay consistent through different market conditions. But I also believe in growth investing, and I also believe in broad market diversification because the goal isn't winning debates in the comments section about which ETF is best. The goal isn't proving I'm right and someone else is wrong. The goal is building wealth in a way that I can actually maintain for 10, 20, 30 years without losing my mind or second guessing myself every time the market dips 5%. If 2026 brings volatility and market swings, I'll be glad I have SCHD providing steady income. If 2026 brings a growth rally and tech stocks continually take off, I'll be glad I have QQQ and VU participating in that upside. That's the beauty of diversification. You don't have to predict the future perfectly. You just have to be prepared for multiple scenarios and stay consistent. So now I want to hear from you. Are you buying more SCHD in 2026, switching to growth, or holding both? Thank you so much for watching, and check out this video right here. Take care, and I will see you next time.